Welcome to your daily stock market summary from MarketSnap. Hey everyone, I'm thrilled to have you here as we dive into the latest action in the markets on this February 17th, 2026. It's been a mixed day with plenty of twists and turns, from tech sector turbulence to some intriguing economic signals. So, let's break it all down for you long-term investors while keeping an eye on the short and medium-term waves that could shape your strategy. Stick with me as we unpack the key moves and what they mean for your wealth-building journey. First up, let's talk about the major indexes and how they're setting the tone. The Dow Jones managed a slight uptick today, inching up by a modest 0.07%, showing some resilience in the face of broader uncertainty. The Nasdaq also nudged higher by 0.14%, though it's still feeling the heat from tech sector jitters. Meanwhile, the S&P 500 posted a small gain of 0.10%, but it's sitting in a fragile technical zone that traders are watching closely. And the VIX, often called the fear gauge, dropped a notable 4.29%, hinting at a bit less anxiety in the market compared to recent weeks. For us long-term folks, these small moves don't scream panic, but they do remind us to stay vigilant. Volatility could still sneak up. Zooming in on the S&P 500 for a moment, we've seen a bit of a stumble recently, with a weekly drop of about 1.39%. Analysts are pointing to a cooling off after a hot streak, with some suggesting the market might be fully priced right now. But remember, as long-term investors, these dips can be opportunities to average in if you believe in the broader growth story, especially with potential tailwinds like AI and Fed policy easing still in the conversation. Over on the Nasdaq, tech weakness continues to drag sentiment. We're seeing a pullback in AI-related stocks, with doubts lingering about massive capital spending in the space. Many of the high-flying names from last year are resetting, and while this might spook short-term traders, it could be a chance for us to reassess entry points into quality names that are oversold. Keep your eyes on the long game. Tech isn't going anywhere as a secular trend. Now, let's check out some of the big winners among large-cap stocks today. Apple led the charge with a solid 3.17% gain, shrugging off recent volatility as investors seem to warm up to its AI potential. GE Aerospace also soared, up 3.70%, riding strong industrial tailwinds. And check out Constellation Energy, jumping 5.05%, a standout in the energy space. These moves highlight pockets of strength even in a choppy market. And for long-term holders, they're a reminder to focus on companies with solid fundamentals that can weather storms. On the flip side, we've got some notable decliners. Southern Copper took a hit, down 5.5%, as metals prices weakened ahead of earnings season for mining stocks. Intuit also slipped 5.07%, caught in the broader software sector sell-off. And SanDisk Corporation dropped a hefty 5.74%, reflecting ongoing pressure in tech-related spaces. While these short-term drops sting, they could be noise for us long-term players. Unless fundamentals shift, consider if these are buying dips for your portfolio. Looking at the most active stocks by volume, Nvidia and Apple are unsurprisingly at the top, showing continued investor interest despite mixed price action. Amazon and Tesla also saw heavy trading, with Tesla slipping a bit today. These names are often the pulse of the market, and for long-term investors, high volume can signal conviction, whether bullish or bearish. Keep tabs on these giants as they often set the tone for broader trends. Diving into the market movers, we see familiar faces like Nvidia and Apple again, alongside Alphabet and Amazon showing mixed results. Palantir also popped up with a 1.23% gain, maintaining buzz around its AI capabilities despite broader sector fears. These movers are critical for us to watch. They often drive sentiment and can offer clues about where capital is flowing over the medium term, even if day-to-day swings don't change our core strategy. Shifting gears to the broader economic picture, there's a lot to digest. Treasury yields have fallen to their lowest levels of 2026 as investors flock to bonds, despite concerns over tariffs and deficits. This flight to safety could signal some caution about risk assets in the near term, but for long-term investors, lower yields might ease borrowing costs for growth companies. Meanwhile, the Fed is keeping a close eye on inflation and AI's impact on productivity, with officials like Mary Daly stressing the need for deep data analysis before further rate cuts. Speaking of rates, Fed voices like Austan Goolsbee suggest more cuts could come if inflation trends back to the 2% target, a potential boost for equities over the medium term if it happens. Let's talk earnings, as this week's calendar is packed with heavy hitters. We've got Walmart reporting soon, which could give us a read on consumer spending amid tariff talks. Medtronic and Alibaba are also on deck, with investors keen to see if Alibaba's cloud growth can offset other headwinds. Palo Alto Networks is another big one, especially after recent software sector carnage. Analysts are expecting a strong double beat, which could lift sentiment if delivered. For long-term investors, these reports are less about the quarterly noise and more about confirming the durability of business models. Are these companies investing in growth areas like AI or consumer trends that will pay off over years? That's the lens to use. You can find exclusive earnings transcript summaries on MarketSnap to dive deeper into these results and what they mean for your investments. Peeking at the top performers over the past week among large caps, T-Mobile stole the show with a massive 14.72% surge, likely fueled by strong sector momentum. Global Foundries also impressed with a 12.13% gain, showing chip demand isn't dead yet. Equinix rounded out the leaders with an 11.16% jump, benefiting from data center growth. These weekly movers can hint at emerging trends, something to consider for your long-term allocations if the story holds. On the other end, Shopify got hammered, down 18.86% over the week as e-commerce faces scrutiny. CBRE Group dropped 16.79%, reflecting real estate sector concerns, and AppLovin shed 14.89% amid the software panic. These weekly losses sting for short-term traders, but for us, they're a chance to ask, are these temporary overreactions or signs of deeper cracks? Patience and research are key. Wrapping up with sector performance over the past week, industrials topped the list with a 2.43% gain, showing strength despite broader market wobbles. Energy wasn't far behind, up 2.15%, as geopolitical tensions eased slightly. Basic materials and utilities also posted gains, reflecting some defensive rotation. For long-term investors, these sector moves can guide where to overweight. Industrials and energy might offer stability if macro conditions hold. On the weaker side, technology lagged with a 1.42% drop. No surprise given the AI spending fears. Financial services barely budged, up just 0.03%, as rate uncertainty lingers. Healthcare also struggled, up only 0.22%, reflecting broader risk-off sentiment. While these short-term sector dips might not shift your core holdings, they're worth noting for tactical adjustments or rebalancing over the medium term. That's a wrap for today's stock market summary from MarketSnap. Thanks for tuning in, and I hope this breakdown helps you navigate the markets with confidence. Be sure to stay engaged with our daily summaries and dive into our in-depth SWOT analyses on MarketSnap for the actionable insights you need to build lasting wealth. See you tomorrow for more market updates. Keep investing smart.